Sanjay Swaroop joining in. He's Chairman and Managing Director at Container Corporation. Mr. Swaroop, thank you so much for your time to us here at NDTV Profit. Always a pleasure to have you on. I just want to talk about the revenue number for a second. It's seen an uptick of 3%, of course, driven by Exim. But the expectation of revenue number was a bit higher. Do you think that there has been a drag over there this quarter? How are you looking at it?
Good morning to you. Definitely, we had expected some more numbers in top line, but we had some subdued demand in domestic segment. Plus, in Exim segment also, there was a reduction in our lead by 2.5% because of less demand in North India ICDs. But we have recovered now, and we are in very good course to achieve the good numbers in this quarter and in fourth quarter also. Incidentally, the Q2 was the best ever for the company in terms of performance of total throughput. We achieved 1.44 million TEUs, which are ever highest in the company's history. And top line and PAT are also ever highest in company's history in a quarter. So that way, it was a satisfying quarter for us. But we hope to do much better in the subsequent quarters.
That's true, sir. But for FY26, you have guided for a 30% domestic volume growth and 10% Exim volume growth. So far, like we said, Exim is meeting that guidance, domestic is not. So are you revising your FY26 guidance lower as a result of this?
Actually, I had given a forecast of 10% Exim, which we are achieving till now, and domestic we had achieved. I had given a forecast of 20% guidance, and by end of Q2, for the first half, we have achieved 13% growth as against 20% guidance. But now we are quite confident that in the remaining 6 months of the FY, of which already 1 month has already over, we will be able to achieve 20% growth in domestic. The reason is that we are now going to get very good loading in bulk cement in tank containers. As I explained in my previous conference call also, because of the monsoon season, when demand of cement is less, we did not get that much loading that we were expecting. But now we have signed an agreement with Ultratech Cement. We have signed another agreement with Adani Cement also, who are the two major giants in cement sector. And they are quite bullish about their growth in various streams, and we are getting supply of tank containers. It was delayed a bit, but now we are going to get tank containers also. So we are confident that in the remaining half of the financial year, we will be able to meet 20% growth in domestic as given in my guidance at the start of financial year.
Good morning, Neeraj here. Just trying to clarify, when you meet 20% in the second half, but the first half is 13%, so consol for FY26, it will be a number lower than 20%. Am I understanding it correctly?
No, actually for FY26, I had given guidance of 20% overall in domestic. But for first half, we are able to achieve only 13%. So we have to make good of that portion also. Plus, that means for the 6 months, we have to achieve more than 20%. To achieve for FY 20%,
yes,
we have to achieve more than 20%.
Agreed, sir. And therefore, you are saying that you will do that. You will do more than 20% in the second half. So the year at large is 20%.
Yeah, exactly. We will do more than 20% to make good for the first half that we lost.
Got it.
Because cement is going to be a big pusher for the loading in domestic segment.
The other point, Mr. Swaroop, is always, one is volumes, the other is pricing and thereby the profitability. Now, the notes that have come out on your results after the quarter two numbers suggest that the profit after tax number was better than anticipated, and therefore there could be upsides to those estimates for the year at large. Now that you are confirming that volumes will be better than 20% for the second half on the domestic side and Exim, you're maintaining guidance, could it be that the profit numbers for the second half are far better than what you've done in quarter two itself, per se, on a quarterly basis, I mean?
Yeah, actually, as I mentioned in my earlier calls also, we believe in maintaining the EBITDA of 24 to 25%, which we have been maintaining throughout without sacrificing anything on our margin front. At the same time, we are increasing our market share also, which is increasing at all the ports. So this will continue, and let me tell you, expenditure control is a focus area for the management, and that directly positively impacts the bottom line of the company. So we are focusing on expenditure control. Like you must be seeing the very good reduction in the running of empty rakes and empty containers in domestic. In EXIM, we have saved 18% in terms of empty running, and domestic we have saved around 7% for the first half of the financial year. This has positively impacted the bottom line. Secondly, there is a continuous growth in double stacking, which also results in positively impacting our margins. So in this first half, again, we have increased our double stacking by almost 7%, although base has become bigger now. So, and Nhava Sheva coming on DFC, we will be further increasing the double stacking, which will have more positive impact on our margins.
Seeing the rail segment pair up, Mr. Swaroop, in the second half?
Sorry?
The railway segment.
Yeah, rail segment is going to see a very good growth in the second half also, because 95% of our transportation is through rail only. So we will see very good growth in rail segment.
Okay, okay. I think interesting takeaway that cement dispatches are expected to increase, because that's a good parameter or indicator of how the economy is also going to go through. Thank you so much, Mr. Swaroop, for speaking with us. Always a pleasure. That's the management of Container Corp, and while we're having that conversation, one large block deal has also been executed in the company. It's about 10 lakh shares. Seeing that slight spike in the stock price.